A surge in US equities overnight powers up Indian stocks. Realty and IT lead the charge, while FMCG and healthcare lag. Mid-caps underperform.
Eicher Motors revs past Q1 revenue margins and profit expectations, riding on the success of its new model. The stock gains even as analysts remain divided on its prospects.
Bharat Forge is likely to raise 2,000 crore rupees within the next few months to grow its manufacturing footprint multifold, even as it eyes doubling of its defense vertical in the next 3 years, says the chairman.
And Ola Electric debuts with gains on the bourses, making it the only listed pure EV two-wheeler company. The street now looks forward to the unveiling of its e-bike on the August 15th.
Hello and welcome to Halftime Report. I'm Ekta Batra and with me is Sonia Shenoy. Well, it's turning out to be a session where we are seeing gains coming in from the US because the weekly jobless claims were not as bad as expected. So maybe there is some amount of assuaging of concerns coming in from the US, at least on the macros for the interim. So that's playing well for us. Who would have thought that we started off the week on such a weak note, but have managed to recover with the Nifty at around 24,367, mid-cap index up around 525 points today. Hi, Sonia.
Hi, Ekta. Well, turning out to be really good, right? I mean, in terms of trade, and just look at that, 24,300 is holding at the moment. In terms of individual stocks, it's largely the frontliners, which are the large caps, which are making sure that the going is good. In fact, the auto stocks are the big movers right now. Eicher Motors is your top gainer, up almost about 5% post its numbers. Tata Motors and a couple of others like M&M are also leading from the front. And then you have some of these IT companies, so HCL Tech, TCS, LTI Mindtree are your top movers as well. But Ola Electric has made its debut, and it's a strong debut at that. The stock listed on the NSE at 76 rupees. Do note this makes Ola the only listed pure electric vehicle two-wheeler company. My colleague Ritu Singh caught up with Bhavish Agarwal, the chairman and managing director, to talk about the new listing and their business outlook. Listen in.
It's very exciting to see the investors put their faith in us. When we did the listing and we did the pricing and the IPO, we wanted to price it in a way that enough investors see value and join the journey for the long term. As I've said, this is this Ola Electric story is a story of India's future. We are building India's future supply chains, India's manufacturing, India's future products, and our ambition and mission is to really build India's leadership on the global stage. So the fact that the street has liked our story and liked what we do, like the price, is a very strong positive. Price will move up and down. I'm learning the ways of the market, and we will keep doing our work. We'll keep focusing on building good business, building strong products, good products, building a sustainable business also, and hopefully creating wealth for investors in the long term.
So far in your very fast pace of growth that you've seen, while revenues are now crossing 5,000 odd crores, losses have also been expanding to about 1,500. So I just wanted to understand if that now starts to change as your responsibility as a public listed entity that is looking to return some value to its investors and stakeholders. How soon do we see that start to change?
Well, Ritu, like we saw in the numbers that we published in our prospectus, our revenue grew up in FY24 by 90%, almost 5,300 crores. And our EBITDA margins also improved from negative 43% to negative 19%, so about a 24-point jump. And that is actually the direction we have been working on already for a while, to build a sustainable business in terms of healthy, good, profitable business. We're not there yet. It's a journey. It's a very young company. It's about a 4-year-old company in operations. Our focus will be to build profitable growth for investors to also feel that there is a long-term profitability journey here also. Now, in our business, there are two themes which I want to communicate to your viewers about how profitability will come across. Firstly, this is a manufacturing business. And in manufacturing businesses, once you invest into your factories, into your technology, and then you sweat the asset more as volume goes up. That's what's been happening already. You can see that's why FY24 numbers were 24 points better on the bottom line. And you can just extrapolate where that curve becomes positive. Our Q1 results will be in the near term. You will see a certain movement in that direction in Q1 because the volumes in Q1 already were higher over last year. These are all public data in Vahan. As we continue to grow into the capacity that we've already installed, margins will keep improving. The second important theme is the vertical integration of the core EV-centric components, especially the cell. Now, the cell costs about 1/3 or the 30% of the whole vehicle.
Yeah.
And all these cells are today imported from large global companies which charge you a bomb. Yeah. And then you have to pay duty bringing it into India. As we bring our cell into commercial production next year, we will save all that margin and that duty. So that will also further improve our gross margin and hence our bottom line. So we're very focused on building in this direction.
Sure.
I can't share numbers, but this is the direction in which we will go along, and our focus is to build profitable growth as we go along.
Well, can you share a direction in terms of sales as well in the context of what's happening with the FAME subsidies tapering off in the last 2 years in a sustained manner? You've also heavily, been following this discounting strategy. I know you said it's tactical, targeted, etc. Is that going to be the strategy going ahead? Do you hope to exceed those numbers, or do you think sales will take, some sort of a beating or some sort of a slowdown with these subsidies going away?
Ritu, I think the broader story that's playing out here is the penetration story of electrification of EVs in India. 3 years ago when we started, almost to the day, EV penetration in two-wheelers was almost zero. Now it is 6-7% overall, and within scooters, where all the action has been over the last 2 years, it is 15+%. And the scooter penetration month on month is only going up. 2 years ago, the government used to give 60,000 rupees in FAME subsidy. Now they give 10,000. And the industry, not just us, but the whole industry has adjusted very well. They've rejigged the cost structures, and the industry continues to grow with reduced FAME. I believe this is the way of the future. Slowly, the incentives will taper down as companies become more stronger in their supply chain and their cost structures to be able to deliver profit margins with probably no subsidies in the future. So that's been our focus on discounting. Like you said, there are tactical discounts that all companies do. We also do that. But once you see our financial results, you will be able to see how that plays into the broader strategic theme of investing into creating supply chains and vertical manufacturing, which lowers our which lowers our cost structurally.
No, but the headline number, let's say you sold more than 3 lakh scooters last year. Will that kind of a number continue or even grow in this year, you think?
Well, if you see our July numbers in Vahan, we sold 40,000 odd, maybe more than 40,000, 41,000 or something. Yeah, so if you multiply 41,000 by 12.
Sure. Well, let me quickly also, before we let you go, ask you about this question which has been raised by several, industry watchers about you as a founder being very heavily involved in the company, and you as a founder not just being involved in Ola Electric, but you also have Ola Cabs, you have Krutrim, you have food delivery with ONDC, and now we're hearing you're looking to foray into quick commerce. How is your attention going to be divided across these?
See, we as a group have 3 companies. There might be different business units in each, but there are 3 companies. There is the Ola consumer business, which has the cabs, the financial services, the commerce, whatever we're doing. There's the Ola Electric business, and there's Krutrim. Now, each company is in a different stage of its evolution. Ola Electric is in a very aggressive growth phase, and a phase where we are investing for future growth. A very large majority of my time, and my time is not 8 hours a day, you know that. My time is, I don't want to say it, people will say, he works too much, but I work more than 100 hours a week probably. So my time is very largely devoted to Ola Electric's journey, and I am involved in all other businesses at a strategic level. Yeah. We have very strong teams in Ola Electric and across our other companies also, which manage every operational detail. But for those who know my style as a founder, I like to look at the detail in everything that we do. So we make sure there is no stone left unturned to deliver a good execution in the end.
Okay, 100 hours a week is what he works. So that's the word coming in. That's what you need to put in, and attention to detail. So that's Ola Electric. After a flat listing today, it has picked up pace. So at the high point, up around 19%. Issue price was 76 odd rupees, currently trading at over 90 odd rupees. We'll take a short break. We'll connect with the management of Kaplan Point Labs to discuss their Q1 numbers. Stay tuned. Welcome back. Well, let's get talking to a couple of companies then. Kaplan Point reported what was a good set of Q1 numbers. Revenue grew in double digits. Margins came in steady at 33%. Q1 numbers were aided by new launches. To discuss this and more, we have Vivek P., who's the COO of Kaplan Point Labs, joining in. Vivek, hi. Thank you very much for taking the time out. Well, let's start with your revenue breakup. You get majority of your revenues from Latin America. But give us a sense in terms of how exactly did the Latin America geography do for you, as well as the US, which is basically Kaplan Steariles.
Yeah. So our base business in LATAM grew well. We're already at a certainly large number at this point compared to other companies that have businesses in LATAM. So at this point, the split is around 82% of our revenues coming in from LATAM. But the US is really picking up pace in recent quarters, and from what it was a few years ago, which was less than 5-6%, today it is close to around 18-19%. So we're happy with the growth at both the markets. Yes.
But could you quantify the growth for us? How much did each geography grow for you this quarter? How much business did you generate in terms of EBITDA from both of the geographies as well?
Yeah, so obviously coming off a smaller base, I think the US grew close to 70%, 69-70%. And the base LATAM business is in around very early teens. I would say that this year the outlook also will be something similar to what we are seeing this quarter. But yeah, I think so far, what we've given guidance out is that we should be comfortably crossing last year, and the US is obviously of a lower base coming in at a higher number.
From ophthalmic products, what is the kind of growth that you're looking at? Any further approvals that we can expect?
Yeah, so we are looking at 2 more approvals, hopefully before the end of the year. The ophthalmic is quite niche as we speak. When it comes to sterile product manufacturing, both injectables and ophthalmics are pretty much in the same manner. And for us, we not really focus too much on the retail space, which is where the ophthalmic part is. But now, with a bunch of approvals under our belt, we might be relooking at that part right now. Actually speaking, we are setting up our own front end in the US, where the focus maximum is going to be on promoting our own label, which is very similar to what we do in Latin America. And I feel ophthalmic is going to augment that piece as well.
Okay. I just wanted to touch upon that plan about starting your front-end business. You have indicated, and correct me if I'm wrong, but you would be looking to source products from CMOs in India and basically start marketing it in the US as well. It would be sourced from wholesalers in the US as well. So your primary aim is to actually become a brand in the US. Why is that so important for you? And in the near term, because of that plan, which is expected to be executed by October to November this year, will it impact your margins?
Look, we've always seen ourselves as much more of a distribution and marketing company with a strong back end. And if you look at our Latin American business, only around 55-60% of the products that we market in LATAM is manufactured in-house. The rest of it is all outsourced, mostly out of China, from very highly quality conscious companies, and also in India. So taking a leaf out of that book, we want to try and replicate the same thing in the US. For us, we feel, commerce is commerce, regardless of which market you're in. So a differentiated business model is more important than anything that is coming out of technology. But in terms of near-term margins, we expect margins to go up because, as you can see, we're still in consolidation phase when it comes to the oncology facility. We're still in consolidation when it comes to API. The US has turned around well, but going forward, when each of them start to break even on their own, we expect fiscal discipline to be maintained at all the units. We expect margins to increase. But I don't have an exact timeline as to when that will happen. But for us, consistency has always been key. And this quarter is no different.
Okay, consistency is key and this quarter is no different. So you want to leave us with, you said the US grew by 70% in this quarter and looking at 2 more approvals by the end of the year. So what does this mean in terms of overall growth for the US, both for FY25 and 26?
Yeah, we'll do well. Without giving numbers away, I'm sure we'll do well. The only thing I would say is when it comes to sterile product manufacturing, especially for a gold standard market like US, you don't want to be focusing on productivity alone. For us, we have 4 pillars in our company, which we call it as integrity, quality, safety, and productivity. So you want no sort of imbalance in any of that at all. But again, long story short, I'd say we'll do well over the next few years, no doubt.
Just quickly, before we let you go, just a one-word answer. When you said that you expect your margins to move up, any figure that you're targeting, 33% goes to what? 35%? Does it sustain at these levels? Give us an exact figure or a range that we can expect in FY25.
We will be a little bit better than where we are today, but significantly better probably in about 2 years down the line.
Okay, we'll do one thing. We will thank you on that note. Thanks for joining in and speaking to us on CNBC TV18. Let's take a short break. More on the markets and stock-specific action when we return. Welcome back to Halftime Report on CNBC TV18. Well, the hospital company HCG's sale process is in the final lap. Sources tell CNBC TV18 that promoter CVC Capital received 2 binding offers. Nisha Podar joins in with exclusive details. Nisha, over to you.
Thanks for that, Sonia. Yes, sources with direct knowledge of this large sale process in the hospital sector have shared with CNBC TV18 that Healthcare Global has attracted 2 bidders. And what we gather from sources is that Bain Capital, the large private equity firm, as well as the strategic Abu Dhabi-based hospital company Burjeel, these are the 2 suitors who have already submitted their binding bids for buying out CVC Capital's stake in Healthcare Global. Now, remember that CVC Capital is the promoter of this company and owns 60.38% stake. And since a majority control deal is getting struck as part of this process, if the binding bids are accepted and a final offer is accepted by CVC Capital, then this will also trigger an open offer. So all including the 60% stake from CVC Capital as well as the open offer, and if open offer fully subscribed, the total deal size could be about 5,000 odd crore rupees for Healthcare Global is what we gather from sources with direct knowledge. So this particular transaction coming to the final stages after due diligence process has been concluded and final bids have been attracted. Now remember that the founder of the company, who's also a co-promoter, is Ajay Kumar, and he and his family own a little over 10% stake in HCG.
Okay, all right, Nisha. Thanks very much for that important story, which is brewing for a long time now. So let's see whether this deal happens or not. But nonetheless, if in case the deal does happen, even at the current market price, that 60% that CVC holds in HCG will be worth around 2,986 odd crores. And to put it into perspective, they bought around 59% stake, which is majority stake in 2020 for around 1,100 crores. So that's an appreciation of 1.7 times in terms of the PE's holding in HCG, which is a largely oncology-focused hospital. Well, we take a short break, but up next we'll connect with Biocon Biologics to discuss their Q1 numbers. Stay tuned. Welcome back. Well, let's talk about Biocon, which was in focus because it reported what was a mixed set of Q1 numbers. Revenue came in flat, margins declined, but it was aided overall by a one-off in terms of sales from the Eris Life deal this quarter. I did catch up with Shreyas Tambe, who is the MD and CEO of Biocon Biologics, and began by asking him about the quarter gone by in the biologics business and the growth they see going ahead.
On a reported basis, the numbers may look that we've had a 3% growth, but you're right, on a like-to-like basis, there's been a substantial change, and that change is 11% on account of the discontinued branded formulations business that, if you recollect, we had in the past monetized through a strategic alliance that we signed up with Eris Life Sciences. So that, if you account for that, that brings the growth to 11%. But what I also want to point out to you is last year's similar quarter also had a very substantial licensing income that we had posted, which is a part of our business. But this quarter, we've seen the growth on the back of very strong product sales and market shares that we won. So if you look at that part, the growth is actually 19% over a similar quarter last year. So I would say we've had a very strong beginning to fiscal year 25.
Okay. Now your Malaysian plant where insulin aspart has been filed from, it was classified as OAI, official action indicated, in October of 2023. What is the current status of remediation? How much, when do you probably expect a re-inspection and possible approval of insulin aspart?
Yeah, and that's an important point because, as you rightly said, we have already responded to the OAI and the commitments that we had made to the FDA on the CAPAs that we had committed to, which is the corrective and preventive actions that we had proposed in response to the observations that the FDA had made. As you know, there are no outstanding questions on the science, so the product can get approved the moment we've got the OAI status clarified and settled. So we are in the process of having that dialogue. We did engage with the agency, and once they are able to schedule an inspection on site, we're very confident that that will be behind us. What is important for your viewers to also know is that the same site, including the aspart product, has been approved by the European authorities and several other authorities across the world. So we feel very confident about the GMP status and about the product as a whole.
Okay. Bevacizumab, that's filed from your Bengaluru facilities. Status on that?
So we did have an inspection at the site. It was a very large inspection, and it's not just for bevacizumab. In Bangalore, if you know, we have a very large manufacturing site. It has 6 different manufacturing units. So when the agency came with the intent to optimize and bring efficiency to their inspections, they have done a GMP inspection and a pre-licensing inspection, or a pre-approval inspection, as we call it. And they have completed the inspection for bevacizumab and ustekinumab both as pre-licensing, as well as the GMP inspection for the rest of our facilities. So at the end of it, they did issue a Form 483, and there were 10 observations that we received across these 6 manufacturing sites, which we're very confident of responding to in a timely manner.
Okay. So as of now, the bevacizumab approval depends on the remediation of those 10 observations in the Bengaluru facility.
It requires bevacizumab. Right now, again, there are no questions on the science, so the dossier is ready to be approved. But it does require the resolution of the CAPAs, and once you have an inspection, which we have had, it is in a very timely manner that we've actually had the inspection. That the agency will make a determination on the new application we've made for the product. I should remind you that we continue to supply a lot of product to the United States from the very same facilities for trastuzumab and pegfilgrastim that we just talked about.
Okay. Can you tell us about aflibercept? There's a litigation pending there, as well as adalimumab. How is it picked up? You launched it in July of 2023 in the US.
Yeah, aflibercept is a very large asset in terms of its revenues. It's over $10 billion in innovator sales that were posted last year. So it's clearly a very interesting asset. And we have had the opportunity to be the first to file when we acquired it from Viatris. And now, we've recently been the first to be approved in the US as an interchangeable. We've also had approvals in the past in Europe, in Canada, and in the UK. So we feel that the uncertainty around this product are behind us. Now it's the question of launching this product commercially. We have reached a settlement on the patent with Regeneron and their partners in Canada, where we will be launching the product mid of next year. So that has been cleared. We will be talking to them in other territories, and then, of course, in the US, we are in a litigation. So once we have a clarity on how that's going, we should be talking about when to commercialize this product and bring it to patients in the United States.
Okay. Well, there were a lot of questions about debt on Biocon Biologics books as well as the consolidated entity. It stands at around $1.2 billion currently for Biocon Biologics. The company has said that it remains a priority to reduce. But what are the measures that we can expect and the timeline of reduction in FY25? And what is the targeted debt figure that the company will be comfortable with?
I think the first thing that we need to look at is what is the intent and what are the actions that the company has taken. I've said on your channel in the past too that we're very committed to addressing the debt position. Historically, Biocon Group has never been in a position where we've been in a leveraged position here. This is a transformational acquisition, and we've incurred this debt only to make sure that we do this in a manner that transforms Biocon Biologics to a very different league. Having said that, if you see the actions we've taken, we have prepaid part of the loan, 200 million of that, in fact, ahead of time, December of last year. And then early this year, we paid down another 50 million, which is way ahead of time, which clearly shows our intent and action that we are committed to debt reduction. In terms of what would be our comfortable position in terms of debt to equity or debt to EBITDA ratios, I think we should look back in terms of what it has been in the past. That would be a good indicator to see historically how risk averse the group has been. So we expect to move in a direction which will be healthy.
Okay.
And risk balance.
But are you looking to probably get an investor on board when it comes to Biocon Biologics? Maybe the likes of Serum increasing stake, private equity money coming in?
Yeah, I mean, Serum is already an investor in Biocon Biologics. If you know that they have invested in us to the extent of 150 million before and another 150 million later. So we believe that they've been with us for a long time and a very strong investor with us. But there are obviously all the time there is an interest in investors wanting to come in. It's important for us to look at this in terms of how can each of them add value to us strategically. I should also tell you that beyond Biocon Biologics, we are a part of Biocon Limited, which is a very large and strong group in terms of its capabilities and has several options at its disposal to see how we can work on paring down debt. And we are working closely with them to seeing how we can deploy any or all of them.
Okay, let's do one thing. Let's take a short commercial break on that note. Lots more coming up on the other side. Stay tuned. Welcome back to Halftime Report on CNBC-TV18. Those are Trent's numbers, by the way, looking very good. EBITDA coming in higher than what the poll is suggesting at 612 crores. The margins are quite stable as well. And the stock is now about 3% It has been one of the the darlings of the stock market in the last 1 to 2 years. And net profits, revenues higher than expectations as well. Looking pretty good on Trent. But the other stock that's doing well this afternoon rather, is Eicher Motors. So let me just take you through the numbers and what brokerages are saying. Decent set of numbers coming in from Eicher Motors. Revenue growth of 10.5% is what the company has clocked in at 4,390 odd crores. The EBITDA has gone up 14.5% as well. The margins have increased to 26.5% and the net profits are up 20%. In fact, Goldman Sachs has raised their target price on the stock. They said that Eicher Motors has reported a Q1 beat in performance. They've raised the 12-month target price to 5,600 rupees. They talk about how there is a 20% upside potential in the price. And the new Gorilla 450 that was launched has already done 6,500 units of dispatches since the 17 July launch. So they like that. Investec, though, has maintained a sell. They talk about how the valuations appear rich now for the stock at 26 times forward. And the volume growth is expected to moderate going forwards. But that is really the big mover. But it has Trent for company now. That stock as well is reacting to a good set of numbers. Let's dip into a quick break. On the other side, we'll connect with Chandrasekhar Nopani, the chairman of Birla Sugar, to discuss more on the Indian sugar demand. Stay tuned. So really the stock to watch right now is Trent. It's now, gaining further ground, almost 6% higher. And, as we were saying, the numbers are the consolidated net profits at 390 crores is much higher than what they did same time last year and higher than the poll as well. If you look at that big surge in profitability for Trent, of course, we do know that some of its brands like Zudio have been doing very well. The revenue growth is also 56% for Trent right now at 4,100 crores. That's really, if you pull up a one-year chart, right, you'll know that you'll see the kind of trajectory the Trent has had. It's been a phenomenal run, really. Look at that, 12 months, 250% move on Trent and going steady as we speak. But ethanol prices should be hiked, says Chandrasekhar Nopani, the chairman of Birla Sugar. Also, Manisha Gupta spoke to him about the poor state of the textile industry in the country and the need for long-term ethanol blending. Listen in.
I think as far as this sector is concerned, we have now come to a situation where there is a good balance as far as the raw materials is concerned. You would have noticed that earlier that every year the sugar industry has been a glut-like situation. Now I think we have come to a fair balance, and I think going forward, a kind of a predictable policy is set out which can help everybody plan properly as to how they want the industry to grow. Ethanol has come in a big way right now, and ethanol, I think the target by the government is to come to 20% blending by 2025. I think we're hitting a figure of 13.5% now. Hopefully next year, once they are able to allow us to produce more ethanol, we should hit 15 to 18%. But I think, laying out a plan that, okay, you want us to come to this kind of a level, so let's say 25% blending or 20% blending, then set up a roadmap for it. And I think that is what the industry is looking for.
And do you think 20% is doable by next year?
I think it would be a little bit of a challenge because a lot would depend upon the kind of sugar production which we are looking at this season. We are just in the month of July and ending July at the moment. We've still got August and September of the rainy months to go by. And one thing which I think all of us need to appreciate, and that's where the government role comes in, is that sugar is a staple essential product and we can't be short of it. So looking at that, I think the government policies would depend to a large extent on what kind of sugar production we're looking at in the country. The general expectation is that this year we are going to have enough stocks, so there should be no restriction as far as the government is concerned to come back to the policy of allowing us to make ethanol from B-heavy and even possibly looking at exports again. So let's see, I think probably after a month or two we'll get a better idea.
So, the concern about the industry right now is that the policies tend to change season by season, and that also is because one year you're having a good sugar year, the second year you're perhaps not having that. So are you looking at a kind of policy which doesn't change by season but is slightly more longer?
I wish it was possible, but the sugar industry is one industry which is plagued by so many variables. And variables which are beyond the control of human beings, like climatic conditions, floods happens, drought happens, what's happening in Brazil, what's happening here. So a whole lot of factors come into play. So I don't think you can have a static policy. But what we would like to see is a predictability that the government will see, all right, we are looking at this. So, give us information well in advance after years, so that then one can adapt accordingly.
So that's about sugar, which really seems to be having a conversation with the government right now. What about textiles? Because this is another area that you look at. And, I was reading a data some time back that there are 4,000 perhaps ginning mills and 3,000 spinning mills in India, and not all of them are making profit and not all of them are getting their margins in. And then, of course, we've seen a huge price crash. This is another area where we've seen price volatility very, very huge. And if you look at the latest sowing numbers as well, they actually show you the farmer's dilemma.
Why is spinning or textiles in a difficult quandary today? It's simply because of global uncertainty. You've got a war in Ukraine, you've got the Israel-Hamas war happening over there. China has stopped by, and that has kind of, the uncertainty which has happened has reduced the buying, whether it's in Europe, whether it's in America and the other countries. And India being a large producer and a large exporter, we now have a situation where our exports is down. I'll give you a simple data that, for example, in dyed and spun yarn, for exports, we were down last year on 40% as an industry as a whole. And that is no small. And so what happens to that product? Either you dump it in the Indian market and prices collapse, or you shut down spindles. And that's what's basically happened. Some sectors of textiles are reasonably well placed because they have, they're able to make fabrics and export to certain countries. So, but that is only a few. But overall, I think quite a few of the textile players are struggling. And I think,
and what is the way forward then?
It's uncertainty. There is a lot of uncertainty here.
But what are the conversations with policymakers?
So, see, as far as the policymakers are concerned, I think Government of India has very limited incentives or taxes as far as the textile sector is concerned. It is basically a demand crunch which has taken place. There is a demand destruction which has happened. And I think once, hopefully, we are now seeing that there is some kind of stability coming around in the world. Once buying takes off as far as the international markets are concerned, which we are already started seeing a little bit of green shoots coming in. So hopefully by this third quarter of this year, we should start seeing an improvement.
So it is a wait and watch until then.
I think it's a wait and watch here.
How about fertilizers? That's another thing that you look at. So while the budget did talk about natural farming, we didn't hear too much about on this subject.
So I think fertilizer is again a very subsidy-based kind of product as far as India is concerned. And here, again, it is very, very finely controlled by the government. I think they're doing a pretty good job as far as managing it at the moment. There was a bit of shortage last year, and so the government has been able to import. There are budget constraints within the government as well. So, but I think they'll be able to tide over the current situation. But
with the budget now done, and we know what's coming in, and of course, there's going to be a lot of conversations until we see all of that implemented. But what do you see a couple of things that can happen outside budget?
So I think outside budget, I think more capacities are definitely needed within India. So a lot of plans are being there. Whether you take phosphatic fertilizers, we are importing fertilizers today. And a lot depends again on the international scenario, and international prices continue to be firm. China, again, there was a lot of volatility in prices here as well. In fact, China was earlier in the market, then they've gone out of the market, which created, again, a lot of topsy-turviness. So again, here it's a policy which I think the government has to wait and watch and see at what appropriate time when to buy. Because, see, it's a large outgo as far as the government of India is concerned, as far as the fertilizer subsidy is concerned. So, and you can't have a situation when there's going to be shortage in India. So it's going to be a tough act for the government to sort out. But I think they will come out with some policy now. Now that the budget is done, I expect they'll come out with some policy.
All right. So a lot of wait and watch here for a couple of sectors at least, that's as far as agriculture is concerned. But thank you, Mr. Nopani, so much for joining us today.
Thank you so much. Pleasure being here.
Okay, that is on the agriculture space. But getting back to the markets, it's been a really good day so far. So the Nifty is now up 230 odd points. The Sensex is up 750 points. And lots of big movers in trade. Eicher Motors is now up almost 6%. And you have plenty of stocks hitting fresh 52-week highs as well. Ola Electric, by the way, is up 20%. It's an upper circuit and a fabulous start to, on Dalal Street for Ola Electric. So 20% higher than 91 rupees on that stock. A good opening there, and now I think about huge volumes, over 5 crore shares actually being traded in Ola Electric as we speak. Affle India is the other one that's hit a fresh 52-week high today. Lupin is at a fresh 52-week high. Trent, by the way, after its strong set of numbers, is at a fresh high. So keep an eye out on that. 6,000 rupees now on Trent. But on that note, it is a wrap on Halftime Report. Business Lunch will take all the action ahead.